What up? What up? What up? It's Khalid Nathan Aleem, the real estate boy, and we're just jumping in here a little bit earlier so I can set Instagram up. So give me a few seconds, and we jump into this: how to invest in real estate. Where's everybody from? Okay, I think that we are on. All right, guys, this is Khalid Nathan Aleem, the real estate boy, and I do this every Friday. Welcome to my Real Estate Bulls Investor Academy. This is where I teach you how to invest step by step. I'm giving out that information that you got to pay thousands of dollars from other gurus online to learn. I am a licensed real estate agent in Pennsylvania. So if you're looking to buy a home, sell a home, or invest in real estate, I got you. Okay. So today we are on chapter 4. Okay. If you are looking for chapter 1, 2, and 3, what you could do is go to my YouTube page. And if you go to www.followkhalid.com, again, www.followkhalid.com, then you can get to all my information. But among the information that you can get from that site is my YouTube channel. Okay. So I'm going to bring my screen in here and we are going to talk about investing, boys and girls. Okay, so I do this again. I do this every week from 11 till around 12 o'clock. Okay, and this is being broadcast on Facebook, Instagram, LinkedIn, and it'll be on YouTube also. Okay, so let's jump right in here. The first thing that we're going to do is do a small recap. All right, let's do a small recap of the past 3 chapters. So the first chapter was on getting clear. All right, choosing a strategy. Are you going to buy a home to flip, or are you going to buy a home to buy and hold? Okay. We also in chapter 1 we talked about getting clear on the finance method. How are you going to pay for the home? Are you going to use cash, or are you going to use a loan? And we went into depth about that. Then identify where you're going to actually invest at. Where you're going to invest at. Now, most people naturally, what they're going to do is they're going to invest in the area that they live in. Okay. But for some of you, that's too expensive. Some of you might live in what they call it, SoCal or Southern California, and it maybe I think in LA, I think the average home is like $1 million. Okay, so you may not want to invest there, but for most people, you're going to want to look to invest where you live at because you have the most knowledge there. You kind of know what's going on. That's your background. But if not, you need to study the market and understand what's going on in the market so that you can be a knowledgeable investor. That's exactly what you want to be. Then in chapter 3, we talked about finding the money. Where are you going to get the money from? Okay. Uh, know how much you're going to need. How much money are you actually going to need? I mean, what were some formulas in chapter 3? Also, where your money is going. All right. Where is your money going to? We also talked about in chapter 1 as far as writing your why out. And that's important, guys, because there's a lot of moving parts when you're dealing with real estate. Real estate, it's a big payoff, okay? But it's a big so it's an opportunity to get a lot of money. It's also an opportunity to lose a lot of money. So there's a lot of moving parts. So you really want to write down your why so you kind of know, okay, why am I doing this? Because there are going to be trials and tribulations that come up, and it's going to be like, you know what? I'm through. Because really, what does Eric Thomas say? If it was easy, everybody would be doing it. Everybody would be doing this if this was easy, but it's not. Okay, but there is a huge payoff. All right. And last week we also talked about how to increase your savings. You get a paycheck every week. Put some of that away, of course, for taxes, but put some of that away also for investing in real estate. Okay. So we talked about all of that last week. I'm not going to jump into that in depth. If you want to see those those videos, you can go on my YouTube page and it's there. Okay. So let's move on. So now we're talking about chapter four. We're on chapter four, and now we're looking for properties and running numbers. All right. So we got our foundation set up. We already got our foundation set up. We know what we're looking for. We know the area. We know where the money's coming from, and we know what our why is. Okay. Now, why are we setting this up? We want to make confident decisions. Okay. Know exactly when to move forward and when to walk away. Okay, that's important. That's so important because what happens, and listen, I'm gonna tell you this from personal experience. Personal experience. If you feel like hot and bothered, meaning not hot and heavy, hot and heavy to buy a property, that can get you in so much situation. I did that one time. I had money, I had opportunity, and I seen everybody around me was buying properties like, "Oh, I gotta get a property. I gotta get a property." Man, and I just bought something. And the only reason I bought it is because I needed to buy something. And I'm still paying for it. I'm still paying for it. Okay. I probably lost like $25,000 on that particular project. And I'm still dealing with the ramifications from that. All right. So, what they say in basketball, let the game come to you. In real estate investing, you got to let the game come to you also. You can't be so hot and heavy that it's like, oh, I'll just buy anything. No. So that's why you have to know your numbers, know when to move forward and know when to walk away. That's super duper important, okay? Also, run accurate analysis, okay? Use proven metrics to evaluate potential deeds. This is a numbers game, folks, and the numbers don't lie. The numbers don't lie, as they say. With investing, it's different than buying your own house. You may have a home that you bought. That's the mindset is going to be totally different. Why? Because when you bought that home, you had to see the home. That was one of the first things that you wanted to do is go see the home and see the neighborhood so you can get those warm and fuzzy feelings. Okay. When you're buying for investing, going to see the home is the last thing that you're going to do. The first thing that you're going to do is run the numbers so you know, okay, is this a good is this a good investment potential or is this a bad one? Can I go forward? Can I go forward with this? Or is it something that I should pull back and go to the next one and not waste time? And there are tried and true metrics that tell you move forward on this, look more into it, or run or run. Okay. Um, and this will help you identify promising deals. You'll be able to spot opportunities when others miss because there's a lot of beginners out there. There's a lot of beginners, and they look at something and they can't see what they say. You can't see the trees past the forest or something like that. Well, a lot of new investors are like that. They can't see the trees past the forest. Okay, they go to a in a home that smells like cat piss and they're immediately turned off. Where people who are veterans at this or who are very good at this, they may go and see that cat piss and think about money. Okay, so let's move on. All right, so the first thing is start with the pre-approval. Start with a peer approval. Secure financing before shopping. Sellers and agents will take you seriously when you're pre approved. You got to have proof of funds. You have to have proof of funds. Now, proof of funds can look like a number of things depending on how you're buying. So, if you're buying something for cash, then proof of funds is going to look like your bank statement or your broker statement of where you're getting that money from. You need it. You need proof of funds. Nobody's going to take you serious if you don't have proof of funds. So that's if you're buying with cash. If you're buying with if you're buying with a loan, then you're going to need a pre-approval. And a pre-approval is from the bank or your mortgage lender that says, "Hey, this person is pre-approved for this amount." Okay. I won't go too much into that. That can be its own section by itself. But you need some proof that you have the money. You need some proof. You just can't walk up on it and walk up on a seller and be like, "Hey, I want to buy a property." They're gonna say, "Okay, where's your proof of funds?" All right. So you need proof of funds. So you want to shop for that. And I have lenders. If you do need a trustworthy lender, let me know and I'll send you one. Okay. Know your numbers up front. Understand your loan limits and interest rates before making offers. If you're getting a loan, if you're getting a loan, then you have to know what that interest rate is that you're going to get. Now, here's the thing, interest rates change every day. Interest rates change every day. So until you lock that loan in, your interest rate should change, is going to change, but it shouldn't be drastic. So you should get, if you're getting a loan, you should get some type of number from the bank as far as, okay, how much are you going to loan me this money by? Money for. And you should understand what that looks like, okay? Be clear about your strategy. Again, and we went over this in chapter one. Be clear about your strategy. Are you getting an investment loan? Are you getting an FHA loan? Are you getting what type of loan are you getting? Are you getting a hard money loan? Okay. So you want to talk with your lenders, have them give you an estimated cost sheet on what it's going to cost you to buy this particular home, or just come up with a not an imaginary home, but come up with an ideal home. Come up with the ideal home that you're thinking that you're going to want to buy so they can get the numbers so you can wrap your head around the numbers, okay? Let's move on. Uh One second. Okay. Just want to see something. So next is you want to use online tools to preview the market. You got to know what's going on. You got to know what's going on in the market. So you can utilize digital platforms like Trulia, Zillow to understand your local property values and trends. So I mean, you got Zillow, you got Realtor.com. You also have Redfin. Those are probably the three top, and also throw Trulia in there, making it four. And also, I can send you homes. Okay, I can also send you homes. If you're in Philadelphia, I can send you two types. Okay, I have the on market and we have the off market. Okay. So we have the on market and I can send you the off market properties also. All right. So you need, but you need to have the homes coming to you so you can look at them. Okay. And understand what the market is. And also, again, using our friend ChatGPT, using our friend ChatGPT to go out there and see, okay, what's the market like in, I don't know, Frankfurt, or what's the market like in West Oak Lane? Okay. So ChatGPT, Google is your friend. Okay. Artificial intelligence is taking over. Next, compare your criteria. Quickly eliminate properties that don't match your investment goals. What are your investment goals? Now, here's the thing, and this is important. As a first time investor, okay, I always recommend my first time investors for them to buy a turnkey property. Turnkey property means that there's no renovation that needs to be done. There's no renovation that needs to be done. So I always stress that they buy that. Why? Because if you buy a fixer upper and you're doing all of that work, you can do all that work and then find out that this is not something that I want to do because of the work or because of being a landlord. You may found like, oh well, this isn't something that I really want to do. So let me just back out of this. But now you've done all that. You can really find it out a little bit without doing so much work if you do a turnkey property first. Now, your profits is going to be lower, but you're in this for the long haul. You're in this for the long haul. You're not in this for the short term. You're in this for the long haul. Okay. So each opportunity, you don't want to lose money, but you also want to gain some money, but you more importantly is you want to gain knowledge. Okay. Study daily. Regular market research sharpens your eyes for identifying good deals. So you want to look at the areas that you have pinpointed regularly. Okay. For example, let's just say not Philadelphia because Philadelphia is too broad. Okay. But you may want to invest only in South Philly or maybe just West Philly or maybe just North Philly around Temple. Okay. So study the area. You want to study the area and you want to study it daily. Okay. Let's move on. All right. Analyzing the deals. All right, guys, this is the good part. This is the good part. So stick around, okay? And throw some likes in the chat, okay? If you're looking at this and you're enjoying this, if you're on TikTok, give me some hearts. Just tap the screen a bunch of times. If you're on Facebook, give me a like. On LinkedIn, give me a like. On YouTube, give me a like. And on Instagram, also give me a like, all right? Um, so let's talk about the cash flow formula, okay? And I'm gonna give you guys examples of this. So stay tuned. You have the cash flow, which is what? You're taking your expenses minus the income, and this tells you how much money you'll pocket monthly from your investment. All right. Now, this cash flow formula is tricky. Okay. It's super tricky, but it's probably the most basic. The most basic. Because if it doesn't cash flow, what are you doing? Okay. If it does not cash flow, what are you doing? Now you could be buying something for appreciation because you're looking what? To flip it. But if you're looking to buy and hold, it needs the cash flow on day one. At least that. All right. The next is the cash on cash return. And we're going to get more into this. Okay. This percentage shows your actual ROI or return on investment. All right. Run your numbers first. That's super important. Run your numbers first. Always calculate these figures before making any offers. Before making any offers, make sure you calculate these numbers first, okay? These simple steps will help you avoid bad investments, all right? And it's not just one or it's not just two, okay? Each formula lets you know whether you should move forward or not. Okay. So let me show you some examples. All right. Let me show you. And I got these from ChatGPT. Okay. These are formulas that I run, but I figured I would get them off of ChatGPT so you guys can kind of see how easy this is. Okay. If this comes up, I'm not sure why this isn't coming up. All right, give me 1 second to have this come up on our screen here. It seems like ChatGPT is acting a little bit temperamental. Looks like it's coming around a little bit. Okay, bam, here we go. Okay, so here are the top three real estate analysis for beginner investments. Ones that you must know. Okay. The first one is cash on cash return. All right. So this tells you how hard your money's working for you. All right. So what is it? It's the annual cash flow. So you need to add up what your annual cash flow is and you divide it by the total cash invested. Okay. You times that by 100. And again, this tells you how hard your cash is working for you. And you want to be at 8% or higher in most markets. Otherwise, the money is lazy, meaning what? That it's not working for you. All right. So cash on cash, definitely important. The next is the cap rate. Now, the cap rate you're really going to compare to other places, all right? But this is used to compare deals quickly, like I just said. Great for out of pocket or all cash buyers. Now, how do you get the cap rate? You take the NOI, which is the net operating income, and you divide it by the purchasing price and you times it by 100, excuse me. All right. So if it's between 5 and 6%, it's like 7 and 9%, okay, then it's solid. 10% or more, then you can move forward. Okay. You can move forward in your analysis. But the cap rate is more you're comparing different cap rates. Like, for example, in Frankfurt, the cap rate might be on average 10%. In University City, the cap rate might be 6%. So you know what? You know if I'm going to have to invest in one, okay, then I'm getting a better return on the 10, which would be Frankfurt, than if I go to University City, for example. Okay. So your cap rate is really to compare different areas versus saying, okay, this cap rate is 9 or this cap rate is 10. Okay. All right. And the last one, and again, there are a plethora of different There are a plethora of different formulas out there. Okay, these are three quick ones. All right, and this next one is super duper quick. All right, it's the 1% rule. And with this 1% rule, what you're looking at is whatever that home's price is, it should rent out for 1% or more, at least 1%, at least 1%, at least 1%. So if you buy a house, or if the listing price of a home is $100,000, it should rent for $1,000 or more. If it doesn't rent for $1,000 or more, on to the next one. Don't even waste your time. So a lot of these formulas are set up so you're not wasting your time looking at one formula, and then you get to the end of it and you don't wasted all of your time. Okay. So now what I did is I said, okay, let's take an example and let's look at the formula. All right. So I took this example. If we're looking at a 3-bedroom single family in West Philly, the purchase price was $150,000. So it's an investment. So we're getting a loan, an investor loan where we got to put 20% down. So if we put 20% down, that's $30,000. So renovation and closing costs is $10,000. Okay. So as you can see, we're all in $40,000 here. Okay. Um, we're all in $40,000. So we got the monthly rent at $1,700, and here's the monthly expenses here. Okay, so if we're taking the annual cash flow, we take the 1,700 because that's the monthly income, and we divide or we minus the monthly expenses. That gives a cash flow what of $650. Okay, so we take the $650 times it by 12. That's $7,800. So if our total, as I said before, if our total cash invested was the 30,000 for the down payment and the 10,000, which is for the closing costs and renovations, okay, that was $40,000. We come down here, if we divide the 7,800 by $40,000 times it by 100, that's 19.5%. Okay, so our cash on cash return in this one will be 19.5%, which is a excellent cash on cash return. So this would tell me to look more into this property. If we go down to cap rate, I kind of did the same thing. The cap rate was 9.2%. Okay. But again, we're looking at this cap rate is being compared to um, another cap rate. So, for example, if this cap rate was a cap rate, for example, if you're in Philadelphia, you know these places, but the Frankfurt neighborhood and the cap rate in University City was 5, then I would know, okay, if I want more for my money, then I'm going to go to 9.2, which would be in Frankfurt versus University City. But again, this is telling us, okay, should we move forward? The 1% rule, if you see here, uh, 1,500, our cost for this was $150,000. 1% of that is what $1,500. So the rent was $1,700. So this passes the 1% rule. Okay, this passes the 1% rule. So this tells us what? This tells us that we should move forward in looking at this property. Now let's look at a bad deal example. All right, say we're looking at a condo in Center City for $350,000, very super small condo, 1 bedroom. Okay, maybe a studio. All right, down payment is $70,000. Closing costs $10,000. The rent is $1,900, and here's the monthly expenses. Okay, so if we look at the cash flow, this cash flow tells us what, and I already kind of went through this step by step, but this cash flow shows us what a negative not cash flow, I'm sorry. The cash on cash return is a negative 3.75. This is not an asset, this is a liability, as it says right there. Okay. This cap is 3.25%. So as it's saying, this is garbage for an investment property. And our what we were charged $350,000 for this. So that means what? That means that the 1% of that is 3,500. Well, that's more than what the rent would be. So all this is All this is showing that what? The second one is a bad investment. Okay. So I just wanted to show you guys that on how to run some numbers. Next, now what counts as income? Because when you're some of these loans that you're going for, they may count some of the rents as income. Okay. But what counts as income from these properties? Well, your rental income, that's going to be your main source of revenue. Okay. That's going to be your main. Now, where do you find these rentals at? Where do you find these rental prices at? Well, I use Rent-O-Meter. Okay. Rent-O-Meter is a app that you have to pay for, but it takes the data and it says, okay, for 123 Main Street, 123 Main Street, 2 bedroom, 2 bath would be around $1,000 a month. Okay. Or what you can do is you can find comparables in the area that have already rented, but I think the best bang for your buck is the Rent-O-Meter. Okay. Um, or if you have a real estate agent, the real estate agent can go in there and see comparables that have already rented and give you some comparables with that area. Also, if you have laundry services, storage space, or parking fees, these are all ways to increase your bottom line as far as the incomes that you're getting. All right. And you always want to go by conservative estimates. Okay. Always underestimate income and overestimate expenses when projecting future cash flow. Okay. Don't, well, if the best scenario happened, with the best scenario, well, if I got the top of the market rent, most of the time you probably won't get the top of the market rent. Okay. So you really want to kind of use conservative estimates. So again, underestimate the income, overestimate the expenses. Okay. What counts as expenses? All right. This is important because when you're doing cash flow, and you put up your income versus the expenses, where are you getting these expenses? Because you haven't bought the property yet. Okay. Well, the first thing you're going to do is the mortgage. You're going to say, okay, if I buy this house for 150,000 and closing costs is this, yada yada. Okay, all in, the loan amount is going to be, I don't know, let's just say 180,000. Okay. So now you can put that in. You also want to put property taxes in. Okay. So in your formula, you want to put property taxes in. You also want to put insurance in because you have homeowners insurance. So you want to get some quotes, or you can ask ChatGPT all this. Okay. This is important also. You want to budget 1 to 2% of the property value annually for maintenance and repairs because kill this can kill your income. For example, if you have a HVAC system, if you have an HVAC system, the HVAC system goes out, and this has happened to me, and you got to replace that HVAC system, okay, that's $5,000 right there. So if your rent is $1,000 and you got maybe, let's say, $500 for expenses, that's only $500 that you're getting. Okay. So that's going to take you what? That's going to take you 10 months to recoup that. That's going to take you 10 months to recoup that. So you want to make sure that you're putting away for CapEx repairs. All right. And also property management. Now, I suggest everybody try their hand at property management so you can see how difficult it is. And that's what I'm a property manager. So when people come to me and they're like, "Hey, I want to, I'm not, I'm on a fence on whether," I always tell them, "No, you should property management first. Okay, be your own property manager, and then after you get tired of it, then call me." Okay, because it's not for everybody. Number one, and if you have another job, this is another job on top of that. All right, so these are some of your expenses that you need to really put into your minds, put into your budget when you're looking at this to see, does this investment make sense? Because if you, when you're doing the cash flow, and if you're just putting in the projected income minus the projected mortgage, no, that's not it. That is not it. That is not it, man. You'll lose. You'll lose your shirt bad. Okay. And the final one, red flags to watch for. Okay. Well, here's are some of the red flags that you really need to watch for. The first thing is the perfect tenant scenario. If a deal only works with ideal tenants, it's too risky. You want to, oh, well, what about this? What if this happens? What if that happens? What if this happens? If your scenario that you're putting is, hey, because um, rental meter gives you the median rent, it gives you the 25 percentile, and it gives you the 75 percentile. So if you're looking at it and you're looking at the high percentile, okay, I'm going to need the perfect tenant where nothing goes wrong, and that's a red flag. That's a red flag. Okay. Also, high fixed costs. Avoid properties with excessive taxes and insurance expenses. Maybe like a flood zone. You may have a property that's in a flood zone. That flood zone insurance could kill everything. Okay. That flood. Oh, what's going on here? Was disconnected. Wasn't able to stream. Okay. Um, that flood insurance can kill everything. So you want to make sure that there's no high fixed costs with that particular property, and you want to check the property taxes. You want to check the property taxes because property taxes can erode. Property taxes can straight erode the income that you get. Next, depreciation dependent returns. Never rely on future value increases. Focus on immediate cash flow. So don't always get into this. Well, what if? Well, if this happens, if this happens, if this happens. No. What's the situation right now with the property? What's the situation right now? And that's what this is saying is don't be a dreamer. Okay? Don't be a dreamer. One second, one second, one second. All right, guys. Again, that's the end of the presentation. Khalid Nathan Aleem, the real estate bull. If you're looking to buy a home, sell a home, or invest in real estate, I got you. Um, we do this every Friday. So next Friday, God willing, 11 o'clock, I'll stream again and we'll go over chapter 5. And again, if you want to see the other 3 chapters of this, just go to www.followkhalid.com. Okay. All right, guys, I'm out. Have a good Saturday, Sunday, Friday. It's Friday. Have a good Friday.